$7 a week doesn't sound like much, because it isn't. A coffee, maybe a sandwich. Most people spend it without even noticing it left their account. But what if that same $7, the $7 you spend without even thinking, could turn into $2,100 landing in your account every single month? That's exactly the question Owner asked himself. In this video, I'm going to walk you through exactly 5 stocks. I'll show you how compounding works and why any of this is even possible. Then I'll break down each of the 5 stocks, what they do, and why they earn their spot. And in the end, I'll show you how Owner's $7 a week turns into a portfolio worth over $300,000, paying him $2,100 a month in dividend income. But before any of that, you need to understand where Owner was before he started, because you're probably right there yourself. Owner isn't bad with money. He pays his bills, covers his rent, and still has a little left over at the end of the month. He's not broke. He just never knew what to do with the extra. Every time he looked into investing, the numbers felt like they were written for someone else. $500 a month, $1,000 to open an account. He'd see those figures, do the math against his paycheck, and close the tab every single time. Not because he didn't want to invest, he just couldn't find a starting line that made sense for what he actually earns. But what if the starting line wasn't $500 a month or $1,000 up front? What if it were just $7 a week? Not $7 a day. $7 a week. $1 a day. About $30 a month. That's real money, but it's not life-changing money on its own. So how does it become life-changing? That's where compounding comes in. The easiest way to understand it is with a simple example. Say you put $100 into a stock that costs $10 a share. That gives you 10 shares. This stock pays a 5% dividend, meaning it pays you 50 cents per share every year just for holding it. Year 1, you have 10 shares. The dividend pays you $5. You don't take that money out, you reinvest it. That $5 buys you half a share. Now you have 10.5 shares. You didn't invest anything extra. You just let the dividend do the work. Year 2, the 5% dividend is now being paid on 10.5 shares, not 10. So you earn $5.25. You reinvest that to you pick up another half share and a little more. Now you're sitting on 11.03 shares. Still haven't added a single dollar of your own money. Year 3, the dividend gets paid on 11.03 shares. That's $5.51. You reinvest it again. Now you have 11.58 shares. You started with 10 shares and $100. 3 years later, you have 11.58 shares, earning more money every single year, and you never put in another dollar. The money made its own money, and then that money made even more. That is compounding. The reason I showed you this with a one-time investment is so you can clearly see what's actually working. When you're adding money every week, the growth blends in with your contributions, and it gets harder to tell what's doing what. Strip it down to a single investment, and you can clearly see where the new shares came from. Not from you, from the money itself. Now, imagine the same thing happening across 5 stocks with $7 a week. The rest of this video is going to show you exactly that. Owner is ready to start. $7 a week, reinvest everything, let compounding do the work. But he has one more question. Why not just find the single best stock and put all $7 into that one thing? And honestly, my friends, that's a fair thought. If one stock is the best, why would you water it down by splitting your money 5 ways? But here's what Owner realizes. One stock can cut its dividend. One stock can have a bad year. One stock can change its management, lose a contract, or get hit by something nobody saw coming. And if all of your money is sitting in that one name, your whole plan breaks with it. 5 stocks means no single company can take Owner's income away from him. It's not about finding one perfect pick. It's about building something that keeps working, even when one piece doesn't. And the way Owner builds it follows something called a core and satellite strategy. The core is one broad ETF, diversified, steady, doesn't need any babysitting. That's the foundation. The satellites are individual stocks that each do one specific job the core can't do on its own. One targets faster dividend growth, one adds defense, one pulls harder on appreciation. One fills a gap nobody's watching. The core keeps the portfolio stable. The satellites push it from good to exceptional. Owner starts looking. And the first question is simple. Where do I begin? He's not trying to find something flashy or exciting. He wants a starting point that gives him the widest foundation possible with the least amount of risk. That's how he finds his first pick. An ETF, instead of buying one company, owner is buying a basket of over 100 dividend-paying companies in a single purchase. Healthcare, energy, financials, consumer goods, all of it in one holding. He doesn't need to research every company individually or worry about picking the wrong one. The ETF does that work for him. And the numbers back it up. A 3.38% dividend yield with a 10.61% dividend growth rate. Meaning the income it pays owner doesn't stay flat. It grows every year on its own. That's why it's the foundation. Everything else owner builds sits on top of it. First, stock down. For satellites to go, owner has his foundation, but he wants something that grows its dividend faster. The first pick is steady. Owner now wants aggressive DATs, where the second stock comes in. One of the world's largest home improvement retailers. Most people know this company as the place you go when you're renovating a kitchen or fixing up a bathroom. And the reason it works as an investment is that people never stop spending money on their homes. New appliances, repairs, upgrades, that demand doesn't go away in any economy. But what caught owner's attention is the dividend track record. This company has been raising what it pays investors for over 50 years straight. The current growth rate sits at 16.07% a year, with 11.58% appreciation on top of it. The yield starts at 2% lower than the ETF, but that growth rate is what turns a small payment today into a serious one in the long run. Owner has a broad foundation and an aggressive dividend grower. Both work great when the market is moving in the right direction. But what happens when it's not? What happens during a recession, a crash, a year where everything seems to be falling apart? Owner wants something in his portfolio that keeps paying him no matter what's going on in the world. The third stock is exactly that. One of the largest utility companies in the world. It generates and distributes electricity to millions of customers and runs one of the largest renewable energy operations on the planet. And the thing about utilities is simple. People pay their electric bill no matter what. In a recession, in a market crash, in a pandemic, the lights have to stay on. A 2.69% dividend yield, 11.32% dividend growth, and 11.26% appreciation. The numbers aren't the flashiest in the portfolio, but that's not why it's here. It's here because when the market has a bad year, this stock keeps paying owner while everything else is trying to recover. Owner's portfolio was missing a safety net. Now it has one. 2 picks left. Now owner wants something in his portfolio that pulls on both sides, appreciation and income at the same time. A stock doing double duty? The fourth pick checks both boxes. One of the biggest investment banks in the world? It makes money from trading, managing wealth, advising companies on deals, and overseeing billions in assets. When markets are active, this company is active. And this isn't a company that showed up yesterday. It's been around since 1869 and has survived every financial crisis since. What makes it stand out in owner's portfolio is the combination. The highest annual appreciation of any pick he's made so far. And right next to it, almost equally aggressive dividend growth. The stock price climbs fast and the income it pays owner grows at nearly the same pace. Every other stock in this portfolio is a name most people have heard of. But owner's fifth pick isn't like that. A company that finances farms and rural housing across America. Think of it as the backbone behind American agriculture. Farmers need land, equipment, and infrastructure, and this company helps make that financing happen. It's been doing this since 1988 and fills a gap in the market that almost no other company touches. It doesn't show up on trending stock lists. And owner almost missed it. But then he looks at the numbers and everything changes. The highest dividend yield in the entire portfolio, 4.34%. The highest dividend growth rate in the entire portfolio, 23.48%. And second place for annual appreciation, right behind the investment bank. In every single metric that matters for building long-term dividend income, this stock leads. Now owner has all 5. The broad ETF for a solid core, the home improvement company for aggressive dividend growth, the energy utility for defense, the investment bank for double-duty appreciation and income, and the stock nobody talks about, the agricultural finance company, leading every major metric in the portfolio. He's putting $1.40 a week into each one. That's $7 a week total. That's it. And here's what happens when all 5 run together. Owner's portfolio blends out to a 2.93% dividend yield, a 16.21% dividend growth rate, and an 11.79% average annual appreciation. And that dividend growth number is what makes this whole thing work over the long run. But numbers on paper don't mean much until you see what they actually do to Owner's money. After year 1, Owner's portfolio is worth $364. That's basically just what he put in. Nothing exciting, nothing that would make anyone look twice. By year 10, it grows to $7,613. Still not life-changing, but more than double what he put in out of pocket. Something is clearly happening underneath the surface. By year 20, it hits $45,995. Now it's real. Owner has put in less than $8,000 of his own money at this point, and the portfolio is worth 6 times that. And then year 30. Owner's portfolio reaches $301,553. The dividend income it pays him that year is $25,288. That breaks down to $2,107 every single month. Owner invested $10,920 total. Every dollar he ever put in over 30 years. His portfolio gave him back $290,633 on top of that. $168,757 from his stocks growing in value, and $121,875 from reinvested dividends doing exactly what we talked about earlier. My friends, here's the bottom line. Owner isn't special. He doesn't have a big salary or a magical starting capital. Just $7 a week, the right 5 stocks, and 30 years of patience. And the beautiful thing? Compounding asks for patience, not intelligence. It wants an early start, not perfect timing. It wants consistency, not big amounts. $7 starts this week. 30 years later, Owner looks back with a smile and understands that the most important decision was the decision to start. Don't forget to subscribe to the channel and turn on notifications. See you in the next video, my friends.